Here's the expanded beginner trading lesson on risk to reward ratio and expectancy. You know, as traders, we're always on the lookout for new ways to improve our craft and increase our chances of making money in the markets. Today, we're going to dive into one of the most critical aspects of trading, the risk to reward ratio and expectancy. These two concepts may seem complicated at first, but trust me, they are not as hard to understand as you think. So, let's start with the basics. When you place a trade, there are two things on the table: risk and reward. Risk is the amount of money you're willing to lose if the trade doesn't go in your favor, while reward is the profit potential. The risk to reward ratio is essentially the ratio of these two values. Think of it like this: imagine you're at a casino, and you have the chance to win a big prize, but there's also a chance you might lose money. For example, let's say you're playing a game where you can win 1,000 if you bet 100. In this case, your risk to reward ratio is 110. For every dollar you risk, you potentially earn 10. That's a pretty sweet deal, right? But what if the game only pays out 110 if you win? Suddenly, the ratio drops to 11.1, and it's not as attractive anymore. Now, let's look at a trading example. Imagine you're trading a stock with a 50 price movement potential. If you risk 50, you're aiming to make 100. In this case, the risk to reward ratio would be 12. You're risking 1 unit for every 2 potential profit units. In trading terms, the risk to reward ratio is often expressed as a ratio, for example, a 13 or a 31 ratio. A high risk to reward ratio means that for every dollar you risk, you're aiming to make multiple dollars. This ratio can vary from trade to trade, but the goal is always to keep it as high as possible. Now, let's talk about expectancy. Expectancy is essentially the average return on investment you can expect from a trade over time. It takes into account both the potential rewards and the risks involved. Using the same game analogy, if you play a game 10 times and win 50 of the time, but make a lot more money when you do win, your expectancy would be higher. But if you play the same game 10 times and lose 5 times, your expectancy would be lower. A higher expectancy means you're more likely to win in the long run, but it's not a guarantee. Trading is inherently uncertain, and there will always be fluctuations in returns. Think of it like this: imagine you're trying to predict the weather. You can use all sorts of tools and methods, but there's still a chance that the forecast will be wrong. Now, here are a few common beginner mistakes to watch out for. One mistake is having a low risk to reward ratio. This means you're risking more money than you can afford to lose, or you're not earning enough profit potential. For example, if you're risking 1,000 to potentially earn 100, that's a ratio of 10.1, hardly worth the risk. Another mistake is not considering expectancy. This can lead to a misleading picture of performance. For example, if you're winning a lot of trades, but they are only profitable by a small margin, your expectancy might be low. On the other hand, if you're losing trades, but they are only small losses, your expectancy might be high. Now, let's move on to the practical exercise for this lesson. I want you to go to a demo chart or paper trading journal and practice finding high risk to reward trades with high expectancy. Look for stocks or indices with potential price movements that could yield a 50 or higher return, and calculate the risk to reward ratio and expectancy. Here's an example: imagine you're looking at a stock with a potential price movement of 50. You risk 100 to potentially earn 250. In this case, the risk to reward ratio is 12.5, and the expectancy is high because you're earning a significant profit potential. Remember to always trade with caution, and never risk more capital than you can afford to lose. And here's a helpful tip: aim for a risk to reward ratio of at least 12, and aim for a high expectancy by focusing on trades with the highest potential rewards. In conclusion, Understanding risk to reward ratio and expectancy is key to successful trading. By following these concepts, you'll be better equipped to make informed decisions and achieve your trading goals. One final point: don't get too caught up in the numbers. While it's essential to consider risk and reward, it's equally important to trust your instincts and make trades based on your